Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialists, Oriane Parmentier and Ian Vanderhorn. Okay, so we're recording this off the back of a relatively calmer week in markets, I would say, compared to the March moves that we got used to. Markets appear to be quite comforted by the ongoing ceasefire in the Middle East. There's plenty of talk of the potential for further negotiations, and we're seeing a lot of reversal of the sort of those significant market moves that I mentioned that we saw in March. So we're seeing equity prices continuing to rebound and rates repricing lower and yields still. I think that is probably the best place to start. You know, if we look at the moves that we've seen in risk assets and equity prices in particular, you might assume that actually the war is over and that we can all move on. Albeit rates are telling a little bit of a different story. We haven't yet recovered to pre-war levels when you look at fixed income, and certainly when you look at things like bank rate pricing and ECB expectations, for example. So I guess a bit of an open question to begin with, and I'll start with you, Ian, but how are you thinking about US rates catching up with risk assets here? Do you think we can get back to pre-war levels in US rates?
So I'm not yet sure about pre-war levels. We still have a ways to go here in the US. We're still about 35 basis points away when we're looking at the front end of the curve. But I do think the front end of the curve has more to go. You know, 2-year yields are trading at the upper bound of the Fed funds rate even today. We're looking at about 3.75% in the 2-year rate. So that's right at the upper end of the Fed funds. And that's holding despite markets having shifted into an easing bias. But you're right, I think there is an interesting dynamic between risk assets and yields so far in April. We've seen risk rally pretty hard, but rates have fallen less aggressively. We have had hiking get removed from the profile at the end of March, but the rally hasn't really followed through all too much since then. So I think one of the read-throughs here is that as we enter the phase of, call it de-escalation between the US and Iran, it's going to be sort of today's data and today's economy that are coming back into the, forefront for markets. As we know, and as we've talked about, I think extensively on this podcast, one of the risks of the war was that future growth would be hit alongside more near-term impacts to inflation. So there were really two schools of thought between those push-pull dynamics. The school of thought would be, one, the Fed would be forced to do nothing, or it would be forced to hike because of the energy shock, or that the Fed would be, able to ease because they look at this energy shock as being transitory and be a little bit more concerned about growth and the labor market. And, it was the latter that was and really still is our view. But then going back to the question, the rally in equities sort of pushes a little bit back against that. If we have risk assets performing well, we've seen some pretty good earnings actually coming out of companies this week, including from banks, and they're setting decent guidance as well. But more broadly, if equities are doing well, then at least for now, the growth risks look, I'd say, pretty minimized. And then if we layer in the recent data, we had a March employment report, that was pretty strong. We've had inflation data come in over the last few trading days here in the US, PPI this week, CPI to end last week. Both of those beat expectations to the downside at the core level. That said, it was not, enough of a beat to really pull down expectations for core PCE, which is what the Fed targets. But then finally, we also had the Fed's beige book this week that really showed that the economy was facing uncertainty related to the war naturally, but really in no way or in very few ways was struggling. So if you look at these few, call it good things, good risk asset performance, which you flagged, the S&P 500 is at, if you can believe it, all-time highs, then we have decent economic data, decent considering the shock at least. These really speak to the Fed doing nothing for now. And, that's really not that unreasonable. And I think that's what rates markets are pricing And that's really what's causing sort of this divergence between risk, which is taking off because, the trend for the war is towards de-escalation and diplomacy. But that is sort of feeding into rates, having the effect that, hey, maybe the Fed doesn't need to act right now because stuff is pretty good, to put it simply. So just from our perspective, we don't have a Fed cut on the docket anyways for another 6 months, but our belief really is in the direction of travel for the Fed, that cuts should be priced in, more cuts for the full year should be priced in, at least more than just the 10 basis points that's in markets right now. But really, yeah, I'll just be curious to see how the data holds up, and particularly we have retail sales next week, so I'll be curious to see how consumption holds up. But I guess just to put a wrapper on this, and to your original question, yes, I really do think that rates can follow, especially in the front end. But the data, in my view, is really what's back in the driver's seat, less so the war. And it could take a little bit of time for that story to unfold here. But I know that it might be a little bit different from how you're thinking about it over there in the UK. So Imogen, how are you thinking about that over there?
Yeah, I think it's different in some ways and similar in others. I guess the way that it's different for me is that I think the case for higher yields is a bit clearer, perhaps in the UK, and that sort of transcends whatever you think about any potential outcome of the war and ceasefire and the path to peace, etc., etc. And what I mean by that is that, firstly, I'm a little bit worried about the kind of lasting economic impact of the war, in that, I'm not convinced, as probably nobody else is either, that global energy supply chains return to normal particularly quickly. There's obviously will be lots of uncertainty abound, even in the case of any, more permanent deal or agreement. There's lasting damage to energy infrastructure that will take some time to repair and replace. And these things all point to a kind of inflation shock that's already in the pipeline and not easily reversed, regardless of what happens with negotiations between the US and Iran. Um, and, you know, I think we can go on to talk about this a little bit more, perhaps when we talk about, the Fed and even the ECB. But I think that this is more of a problem for the UK. It's a central bank that doesn't have a kind of dual mandate like the Fed does, and it's a central bank that hasn't really already achieved its price stability objective like the ECB had. The BOE is still fighting the last war on energy prices. It's an inflation problem that is going to be more problematic in the UK, I think, potentially, for a central bank that's still kind of scarred from that past energy shock. We're still reeling from the effects of that. We still have service price inflation above 4%, 4 years on from that 2022 energy price shock. I think it's not difficult to make the case that rates shouldn't be pricing in as optimistic an outlook as risk assets are, and perhaps looking at it through a different lens, there isn't as much of a disconnect as you might sort of optically think when you just say, oh, equities are back at pre-war levels and rates are not. And what I mean by that is, when you look at the data, a little bit to your point, Ian, we've had strong GDP data out of the UK this morning, but actually nominal growth in the UK has broadly been okay over the past couple of years. And, it's that nominal growth that can probably still support risk asset valuations returning to pre-war levels, even as rates markets are telling us that we can't get to that pre-war pricing because of the potential inflationary impact. And so I'm not sure that rates necessarily need to get back to pre-war levels for this kind of market pricing to make sense. And then maybe I would just add about sort of the level of yields further out the curve, because we've been sort of fundamentally bearish gilts for well, for I guess as long as I can remember really now. I can't remember a time when I thought that gilts looked particularly cheap. But I really think that the war has re-emphasized those bearish risks. And that's not just about the inflation outlook and what it means for bank rate potentially, but also about the fiscal backdrop. Of course, those two are sort of intertwined. One of the UK's fiscal issues now is how high its debt servicing costs are. A couple of facts that I like to spew from time to time are that the net interest expense as a percentage of GDP is greater in the UK than it is in the US, which is quite astonishing, really, and that we spend more on servicing our debt interest every year in the UK than we do currently on defence. So about 10% of public expenditure in the UK goes to servicing debt, whereas about 6% of total public expenditure this year is projected to be on defence. So we spend about as much on debt interest as we do on education in the UK. When you consider or compare that to the euro area, it's probably about half as much. So, it's a huge issue for the UK that rising rates present. From a debt sustainability perspective. Now, you might argue that the longer weighted average maturity of debt in the UK cushions the blow a little bit. But of course, we all know that the DMO has been making a huge effort to shrink the weighted average maturity of debt in recent years. And also the redemption profile of gilts is very high in the coming years. So we have a significant amount of refinancing risk into this higher rate environment. And of course, the final point I would make related to that is that the UK has a very large proportion of inflation-linked debt compared to most of its peers, and so in a rising rate and high inflationary environment, there's kind of a double whammy of debt servicing cost risks to the UK. So that adds to, other fiscal risks that war generally presents. And even if, as I was saying before, even if we get some kind of resolution or ceasefire, I don't think that removes the call or the push for increased and accelerated defense spending. And it doesn't necessarily, because it doesn't erode that inflation impact, it doesn't necessarily reduce the pressure on the government to also potentially spend more to protect consumers and businesses from those rising energy costs. So you've got kind of front-end inflationary bank rate risks, you've got ongoing fiscal risks, and then finally, and this is something which I think we've spoken about on the podcast before, but it's just the beta of gilts to global moves, which is partly about the changing demand backdrop. We have a higher participation in the market of overseas investors, which makes us a little bit more sensitive to global rate dynamics. And of course, we've got much higher participation from the fast money community as well. And it's partly about that kind of permanent additional premium that gilts now attract, as they have done on a sort of permanent basis since 2022. But all this means that gilts tend to underperform global rates in a sell-off, and that's what we've seen over the last couple of weeks. Rates have moved higher, and gilts generally have underperformed cross-market. And I don't think that a swift resolution to the conflict or any kind of deal or permanent ceasefire peace changes any of these factors. So even if there is kind of optimism abound in risk assets, I don't think it necessarily changes the outlook for gilts. And it's not obvious to me that we should be tracking risk assets back towards pre-war levels across the curve, really, at any point in gilt yields.
Yeah, absolutely. And just because I think you framed those fiscal risks really actually so well, I do think it's worth mentioning quickly that we have those here in the US as well. We also spend as much on interest as on defense. The war is gonna, probably prompt additional spending from Congress as well. And these are fiscal risks that we're considering also, particularly since we run such a high deficit. But just in terms of our views, those are going to weigh a little bit further out the curve, as they will in the UK as well. But definitely a risk we're watching here in the US as well. But just to pivot a little bit to the front end again, what about the front end UK rate pricing versus Europe? I know this is something you've been talking about a lot more this week. What do you see in those differences?
Yeah, it's been quite hot topic of conversation, I would say, this week, to the extent that there are hot topics in the conversations that we have in the bond world. I sort of put a few thoughts out there earlier this week and wasn't expecting it to be such an off consensus view, but it's taken me by surprise a little bit, the extent to which bank rate expectations have repriced in the UK, but that hasn't been matched by a repricing of ECB rate hike expectations. So what we see is bank rate pricing has come all the way down from the highs of like 80 basis points of hikes being priced in 2026 to now only around 30-ish at the time of recording. Of course, it's a bit volatile and things are moving around. And certainly by the time listeners listen to this, it might be further away. But anyway, that's where we are at the time of recording. And what we see in the euro area is just shy of basically an additional hike being priced in compared to the UK. So the euro area reached similar peaks in terms of pricing of that sort of 80 basis point level, but it's just come off a little bit less. And of course, I'll let Oriane speak to the European side of the view, and particularly in light of all of the central bank speak that we've had this week. But that the way that those two markets have moved, that rate pricing differential is interesting to me. And I should be clear that actually the UK market now much more closely reflects our base case view. It's probably a little bit hawkish in terms of the timing of those rate hikes. The market thinks they come relatively soon. We're a bit more convinced that if they come, they're likely to be delivered closer to the back end of the year. But nonetheless, I would say that UK bank rate pricing broadly in totality is not that far from our base case view of having, 30-ish basis points of hikes being priced in this year. But it's that differential between what we're seeing between the UK and Europe that I think is wrong. And there's lots of ways to justify this. I understand that the starting point was quite different when we came into this crisis. The ECB had cut rates all the way down to 2%. The Bank of England was arguably sort of still at the tail end of its cutting cycle and hadn't got anywhere near back down to 2%. We're still at 3.75%, 3.75%. And markets were much more confident about at least one more additional rate cut being delivered in the UK compared to the ECB. But I still don't feel like that explains enough of the difference in 2026 pricing. And I would say the pushback that I've had on that view has been centered around two arguments this week, neither of which I sort of subscribed. One of them I don't subscribe to at all, and the other one I don't really subscribe to, but perhaps has a few more legs than the first. The first is that the ECB has more room to raise rates. They got back down to 2%, and so they've got kind of more headroom to play with from a policy perspective. I think that entirely misses the point. The point is that Europe has a lower starting point because it had more benign inflationary pressures. The central bank was able to reduce rates because it was meeting its price stability objective much more successfully than the Bank of England was. A central bank that hasn't yet won its previous fight on inflation is presumably going to be much more alert to risks of second round effects than one that had made much better progress against its price stability mandate. So I don't give that sort of side of the argument much credence. The second is perhaps the one that's been driving a generally more dovish than our view on bank rate over the last year or so, and that's on the labour market and the fact that the UK labour market is in a far worse place than the European labour market, and therefore there's no way that the Bank of England, the hurdle for the Bank of England to raise rates is much higher than it is in the euro area. I'm less convinced. Of course, we see European unemployment, it's been falling compared to it rising in the UK, but the ECB themselves have argued that perhaps the labour market is looser than that overall unemployment rate would imply. And other measures in the UK, if we look at the PAYE data, we look at the ratios of vacancies to unemployed, if we look at average weekly earnings for example, they all appear to have bottomed out rather than signalling kind of significant further weakness. So whilst I can see more evidence for that second argument around the labour market than the first argument around rates being, at different levels and that giving them more dry powder to hike, it's not one that we give a huge amount of credibility to. And I'm not sure that the labour market will prove to be an impeding factor in the UK in the Bank of England hiking rates should they need to, given the inflation backdrop. But perhaps that is a very good moment to bring in Oriane to talk about rate pricing on the European side.
Thanks, Imogen. Yeah, so we've seen quite a notable repricing of ECB expectations as well over the past week with the news flow from the Middle East improving. So markets are now pricing just about 50 basis point of hikes for the ECB this year, with the April meeting essentially off the table. So markets have continued to converge towards our view, but I still continue to see the pricing as too hawkish given what we actually know, or perhaps what we don't know in terms of the broader ramifications of the conflict, the scale of the gross impact, and potential second round effect as well. And I think in that respect, the comments from Lagarde and various other ECB speakers over the past week have kind of reinforced that point as well. I think our stance has been pretty consistent since the beginning of the conflict. We've been saying hiking rates in response to an oil shock could fall outside the ECB's remit, and also could end up being a policy error, in fact. When we were marketing these views just a week ago, when a full hike was essentially priced for April, we titled our trip notes, "Are Markets Getting Ahead of Themselves?" And I think that captured the point well. Markets are quick to price hikes. And we're not pushing back against, insurance hikes being priced in at the time, particularly for June, which I think we still continue to view as the more kind of like logical window for action if it's genuinely needed. But we were clear that April was simply too soon, and we were also always highlighting the fact that the central bank reaction might not be as quick as markets, of course. Now, if we look at market pricing, we have roughly 18 basis point now priced for the June meeting. And with the de-escalation we've seen over the past days, I think the risks lean towards hikes continuing to be priced out, although uncertainty remains very much elevated at this point. But at least I think we can say some form of de-escalation has been or seems to be underway, and it might not be conclusive, but at least the probability of kind of forceful military action or infrastructure destruction, for instance, looks less likely at this stage. Now, having said that, I think we have to admit it's very hard to be geopolitical expert at a time when the whole concept of diplomacy is being revisited, and Trump is clearly not playing by the book. But hopefully and thankfully, actually, the ECB reaction function is, I think, a little bit easier to read here. They operate on a data-dependent, meeting-by-meeting basis, and they've been really re-emphasizing this point during the week. And I think the obvious risk of jumping the gun could potentially be a Trichet style mistake in a way. And I think if you look at inflation market, they also support our general reading, I would say, on what is going to be ECB action in potentially very much for the April meeting, but potentially as well as incoming meetings. We see no sign of de-anchoring in medium-term inflation expectations. And this is, for instance, a sharp contrast with what we saw in 2022. And I think for good reason. The macro context in Europe is quite different from back then. And I would say generally we're still, comfortable with a scenario for no change in rates from the ECB this year, given the more recent developments.
I guess in some ways, Oriane, when you talk about the ECB being easier to read, I don't know if we would call the Bank of England easier to read, but I do think we both have a slightly easier job in the sense that we don't have a new central bank makeup to consider, which of course is is what you are potentially battling with in the US, Ian. Of course, we think we know which way that means the Fed will lean, but there's lots of nuances that I think, make it a harder job to predict the future path of Fed policy. And of course, that was the other key bit of news this week. That was around incoming Fed President Warsh's hearing, which has been set for next week. So what are you watching out for in that hearing? And I guess more broadly, how do you expect him to exert his influence on the Fed over the next, over the beginning couple of months of his term, we should say, given we don't know when exactly that will be?
Yeah, still up in the air, and talk about a topic that's sort of been pushed to the back the last month and a half due to the conflict. But as you mentioned, first Warsh has to be approved for the seat, and that's still a big question mark. But we do have a hearing set for next week, Tuesday, the 21st, and I think that's really just going to be the point where we find out how everybody really wants to play their cards uh, as far as the situation goes. We still have Senator Tom Tillis vowing to block Warsh's nomination until the Department of Justice drops its criminal probe into Chair Powell. He hasn't really let up with respect to that. He's a Republican on the committee. He sees the investigation into Powell as being baseless, not based in evidence, and really just being used to undermine Powell himself. So he's going to continue to block it, so he says, until that probe is essentially dropped by the administration. But it got even more complicated this week, because in addition to that hearing being set for next week, we also heard from the administration and from Trump about what they would do if Warsh is not nominated by the end of Powell's chair term, which is a month away, May 15th. We heard Trump say that he would just simply fire Powell. That would certainly face a lot of pushback, but we heard from the administration, the likes of Bessent, say that they would move to choose somebody in the interim, probably one of the sitting governors there, like Waller, who's actually a prior Trump appointee. So there's a lot of moving parts here. It's very messy and complicated. I sort of continue to question why the administration's strategy and Trump's strategy especially isn't to let this whole thing with Powell go. If I were him, I'd really want to get Warsh in the seat now, or at least May 15th. I'd want him to start trying to lower rates. But when I think about this, I think there's an element of it where Trump is probably trying to exert some influence here with respect to the broader fight that he's been taking up as far as sort of seizing greater executive power. We've seen that as a trend throughout this current administration and the last as well. And just thinking about this, I think a little bit cynically, if Trump forces Powell to stay in his seat past his term, Trump can then blame the Fed. He can say, hey, look, Powell is a guy who's staying past his term limits. He's sort of the one breaking the rules, right? He can also start to blame the Fed for things like the affordability crisis, which will be really important heading into the midterms. He can have his guy to point at and say, hey, look, there's the chair that refuses to cut rates. He's the reason that mortgage rates are so high. He's the reason, you can't buy a house. So perhaps that's the strategy. And if it is the strategy, then it certainly doesn't speak to sort of a quick resolution. Warsh getting in the seat quickly, getting approved quickly, and starting to sort of exert the influence that you mentioned. But I do think thinking forward, thinking past what could be a couple month process, Warsh will get in eventually. The Republicans, including Tillis, who's currently blocking, have no problem with Warsh himself. They have a problem with the administration's probe into Powell. So when the fog does clear, we do expect Warsh to be in the seat. It will just, take some time, and I think next week will be critical for seeing how long that will take. And then just for markets, the discussions will start to center again on what a Warsh-led Fed could look like. So we'll start having the discussion about, is productivity driven by AI sufficient to allow the Fed to ease just because future inflation risks are lower? We're going to have the discussion about potentially the 2% inflation target being what's restraining the economy. too much and supporting the affordability crisis. And then back into play, we'll also start talking about, balance sheet, the Fed's balance sheet, if they need to start divesting assets and using that as a potential offset to any rate cuts. So yeah, this will certainly come squarely back into the forefront next week. I think if we get anything out of that process, it'll be more clarity on the timeline. And then just we can move forward and start looking at what a Warsh-led Fed means, because we do think it means downside risk to the Fed funds rate. That is built into our expectations for front-end rates and for our Fed call. And I guess just as a caveat, because it has come up on this podcast, a Warsh Fed also means, potentially higher acceptance of inflation. And if we layer that into the fiscal risks that we talked about, a few minutes ago, that does sort of weigh on our expectations for the long end of the curve and add to our steepening bias, being a more stable, if not higher in yields long end versus a lower front end. So yeah, that's how we're viewing it. Looking to get just a little bit more clarity out of that hearing next week for Warsh.
It's nice to have something else to focus on away from headlines coming out of the Middle East, I think. And on that note, why don't we just quickly wrap up with looking at what else is on the docket for next week and what else we might be focused on that others might not be. So Ian, I'll start with you again. Of course, you've already been through a big focus of the week, but what's on your radar that might not be on everybody else's?
Yeah, well, that's the big one. I don't know about not being on everybody else's radar because it's arguably even more in focus. But the end of the U.S.-Iran ceasefire technically does end on the 21st. I know there's been a lot of movement towards potentially extending that ceasefire, but if talks come up short, it is Tuesday that marks the official end of that. So that's squarely in focus. And then outside of that and the Warsh hearing, it's just the growth data that I'll be interested in. I mentioned it before, but retail sales, especially, could that sort of pad this optimism that we've seen over the last week, or will it sort of push against it? So that's what's on the radar for me. How about you, Imogen?
So I think I mentioned it last week, but I still think it's a little bit under the radar and I'm still focused on it. And that is the April remit revision. So just a very bit of high level context. Every year we get the spring statement in March and the DMO publishes its issuance plans for the year ahead. And then in April, we get small tweaks to those issuance plans, which basically reflect the fact that by the time of April, we get the full year of the previous fiscal year's public finance data. So we have more detail essentially on whether there's any kind of carry forward financing, whether the DMO is slightly overfunded or underfunded on those cash numbers, given what the borrowing numbers in the year before. So basically, when they publish the spring statement, they only have 11 out of 12 months of data for that previous fiscal year. And by April, they have 12 out of 12 months. So it's unsurprisingly not top of people's radars. There's plenty of other things going on. And in any case, it's never usually like particularly market moving, especially in years where we don't expect big changes or there's not been, for whatever reason, big kind of surprises in the March public finance data. But I'm a little bit more focused on it this year than most, just because obviously since the spring statement in March, we've had quite significant market moves. And that's what happened last year as well. We had in between the spring statement in March and the April remit revision, we had Liberation Day. The curve steepened quite significantly. And that was, I think, part of the reason why we saw relatively big bucket changes in the April remit revision, which wouldn't normally happen. You normally, it's sort of rounding errors of changes that you would expect to see in April. This year, we have the opposite. We've had another big event risk. We've had the war, and that has driven quite considerable curve flattening. And we know that the DMO over the last couple of years has made considerable effort to shrink the weighted average maturity of its issuance. That shorts bucket has been increased significantly and the longs bucket has been cut quite significantly. But of course, with the curve flattening that we've seen over the last couple of weeks, maybe that's just at the margin change the value for money calculation for the DMO. And maybe the risk is, and this is why I'm watching it really, the risk is that we actually get small increases to the longs bucket that people might not be expecting. And so to the extent that I think the curve can flatten anyway, and to the extent that I think markets have been a little bit sleepy on the fiscal risks, on the medium-term fiscal risks in the UK, but also on the fiscal risks as a result of the war, I wonder if that April remit revision could just add a little bit of an impetus for bearish curve steepening next week. And what about you, Oriane? What are you watching in Europe?
Yeah, so in Europe, I think I will be, watching country spreads and notably France. I think there are risks to see further tightening from current levels, assuming the geopolitical backdrop doesn't deteriorate. I found it interesting to see country spread not tighten as much as I would have perhaps expected, considering the rally this week. So I would have perhaps expected to see some better performance here. Of course, country spread had arguably already tightened quite a bit, with market reacted more significantly to positive news than negative headlines, I would say, recently. But I think one obvious explanation is also supply. So we've had a new French 10-year green syndication this week, and Italy came also with a dual tranche deal. This is a risk that I had flagged actually last week on Bondcast. And I think on that note, it's worth highlighting that European governments and SSA issuers more generally have been taking the opportunity to come to market with condition improving. And I also expect more deals before the summer. So that's also, I think, something to keep an eye on as well.
Amazing. Thank you. All right. I think that's probably enough for today. We will catch up on all of this and more, I'm sure, next week. Thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit like and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out our other podcasts, The Currency Exchange and Trade Links. Thanks. See you next week.